Here's a surprising fact. In 2026, the biggest threat to American investors isn't inflation, interest rates, or even market crashes. It's behavior. Despite having more data, more tools, and more access than ever before, most US investors continue to underperform. Not because markets are unfair, but because psychology keeps sabotaging their decisions. Today, we're breaking down the top 5 investing mistakes US investors are making in 2026, and why these mistakes feel logical in the moment, but costly over time. Imagine this. You open your investment app, your portfolio is red. Headlines are loud. Social media is divided. One expert says the market is about to crash. Another says this is the opportunity of a lifetime. You freeze. This confusion is the modern investing environment in America. Information overload, emotional pressure, and constant noise. And while technology has improved, human behavior hasn't. The mistakes investors make in 2026 aren't new, but they're happening faster and more frequently than ever before. Chasing performance instead of process. Many US investors in 2026 are still buying what just went up. Hot stocks, trending ETFs, assets dominating headlines. This behavior was visible during past tech booms and hype cycles, and it continues today. By the time something feels safe, it's often crowded. The mistake isn't interest in strong performance. It's entering without understanding why performance happened, or whether conditions have changed. Letting headlines control decisions. Financial news has become entertainment. Every market move is labeled historic, unprecedented, critical. In 2026, algorithm-driven news feeds push fear and excitement because emotion drives engagement. Many investors react to headlines instead of long-term plans, selling during panic and hesitating during opportunity. The market doesn't reward constant reaction. It rewards consistency. Overconfidence after a few wins. After a good year or two, many investors start believing they've figured it out. They trade more. They take larger risks. They ignore opposing opinions. This happened to countless investors after strong market rebounds in the past. Overconfidence feels like skill, but often it's just timing. Markets eventually humble everyone. Ignoring risk management. In 2026, many investors focus on returns, but ignore downside protection. They ask, how much can I make? Instead of, how much can I lose? This mistake becomes costly during volatility spikes, economic uncertainty, or unexpected events. Risk isn't about avoiding opportunity. It's about surviving long enough to benefit from it. Confusing long-term investing with short-term emotion. Many Americans say they're long-term investors, but their behavior says otherwise. They check portfolios daily. They react to weekly movements. They let short-term emotions override long-term intentions. True long-term thinking requires emotional restraint, not just time. Information has outpaced emotional discipline. Investors in 2026 aren't underinformed. They're overwhelmed. Without filters and rules, more information leads to worse decisions. Simplicity is a competitive advantage. Complex strategies feel sophisticated, but simple, disciplined approaches often outperform over time. Less reaction, more intention. The market exploits human nature, fear, greed, ego. Markets don't change, but behavior repeats. Understanding your emotional patterns is more valuable than predicting markets. Consistency beats brilliance. You don't need to be right often. You need to avoid being wrong in big, emotional moments. Avoiding major mistakes matters more than chasing perfect timing. Process protects you when emotions spike. Rules exist to protect you from yourself. When emotions rise, systems keep decisions rational. The top investing mistakes US investors make in 2026 aren't caused by bad markets. They're caused by emotional reactions in a high-speed, high-noise environment. The market will always test patience, discipline, and humility. If you want more deep dives into investing psychology, financial history, and how to avoid common money mistakes, subscribe, like, and stay focused on what actually matters.